This is Robert Kelley with the Trader's Classroom for Tuesday, April 11th. Today I'm going to answer a question that I got from our subscriber Travis Conley, who's says he's been trading for 3 years and he mostly does scalping. And he asked kind of like, well, what time frame is the best time frame to trade? Because a lot of the analysis that I do here and maybe we have in other services tends to be maybe a little longer term. I mean, I tend to show daily charts. And the question is that the time frame you should be focusing on in your trading? You know, I'm just kind of paraphrasing it. And so I wanted to kind of address that whole topic and explain different angles to this. And I would say that the general answers as to what trading time frame is best is basically what works best for you and your trading personality, also how much time you have to devote to sitting in front of the screen or checking the market. All right, so there's no one right answer to this question, but I want to introduce a concept that I think is going to be pretty easy to understand and show kind of one of the benefits of using the wave principle. So I'm showing this chart here. We're not going to get into any heavy analysis. I did this last week, this analysis of Lockheed Martin, and this count is looking for a minor wave 3 peak fairly soon, maybe in the next week or two, something like that, if this count is right. It's a little too early to be calling a top, but in general, this count looks pretty solid. All right, so I'm just using this as an example, not as an actionable trade idea. All right, and the point and the concept is that the advantage of Elliott wave, one of the big advantages Elliott wave gives us, is that we can apply wave analysis at multiple degrees of trend. So in other words, I showed you the monthly count on this stock, and basically, I have a very long-term wave count, and the implication of the count shown here is for a decline. Once this wave 3 ends, there would be a good chance for a decline back down toward this wave 4 low. Okay, you've got, if this is a diagonal as labeled, Elliott tells us that when a diagonal is complete, you return quickly to the origin of the diagonal. All right, and that, of course, is the end of the previous fourth wave. So that would be kind of a general target for this once we can become a little confident that the pattern is over. All right, so the advantage that Elliott wave gives us is, let's just say maybe it goes up to 510 here in the next couple of weeks, and then we see a 5-wave decline on maybe a 15-minute, 30-minute chart. All right, and then we get a wave 2 up. We got a wave 1 down and a wave 2 up. All right, well, that gives us a chance to be bearish on this stock, placing like a stop above the high for the move, because if we think it's 5 down, it shouldn't take that high out without working at least a little bit lower. Okay, and we have the potential to see that trade work out with a decline down in the low 300s. And let's say the stock peaks at 510, and we have a little 5-wave decline down to like 495, and you have a wave 2 up to like 507 or 505, something like that. You can risk $5 or $10 on the trade with the potential to make maybe close to 200, in a bigger picture trade. All right, so that is what I'm talking about, where you can use the longer term count, and then when there's a short term count that provides clarity and allows for a low risk entry. In this case, if we get a 5-wave decline, we're risking above the high, and let's say we're risking $10 a share on this stock, then we have a $10 risk, the potential over the long term to make 200. So that's a 20-to-1 ratio kind of thing. So that is one reason why you can use the multiple degrees of trend to put a trade on that has much higher risk reward expectations than if you're just trading very short term and using the very short term wave count. So that's one reason, and that's like probably the main reason that I would say with markets we can pick. We don't have to trade one market all the time every day. We can look through all our charts, and whatever you're trading, maybe it's futures, maybe it's forex, maybe it's stocks, options, like any number of vehicles you can trade. But certainly with the stock market, we have thousands of stocks to choose from. Of course, it's too much to analyze, but looking at longer term counts, we can be very selective and look for these high confidence longer term count wave setups. And then once we see the short term count that agrees with the longer term count, that gives us a very low risk entry with a chance to exploit a potentially much larger move that the longer term count tells us to expect. All right, so that's one big consideration. So I would summarize it by saying this way. When you have a long-term count, a bigger picture count, doesn't even have to be long-term, but and you can use a short-term chart with the short-term wave count to give you a small amount of risk on the trade, but your longer-term count calls for a big move. That's an ideal setup. That's something you want to try to exploit. And that's where looking at the longer term is beneficial. All right, now I want to mention a couple other things. Seasonals, we have these indicators that I look at, that everybody has access to. They tend to be a little longer term. All right, so here's a seasonal chart of GDX. I'm just showing it because it happens to have a seasonal peak due on Wednesday and calls for GDX to have a little seasonal decline down into mid-May. All right, so this is an analytical tool, one of many, of course, that we can apply to the market. Now, we don't really have this kind of a tool on a 15-minute chart. I mean, I bet there is actually a service I saw that's trying to do intraday seasonals on the S&P, and it doesn't seem to be. It's kind of experimental, I would say. To see how it's going to work, how the track record is going to be. But anyway, generally there aren't intraday seasonals. Certainly not for every market, every stock. Okay, you'd have to do a lot of computations to do that. So it's easy to access these longer term indicators and look for a projected big move. All right, this isn't necessarily a huge move. This is calling for the decline of maybe 3% down. But so you can stack a lot of these tools on top of each other to get an advantage. And these tools tend to be based on the longer term. I'll show you another one. Okay, so here's another one. And this is not an Elliott wave tool. This is just another tool. You've seen me show this before. This is a cycle analysis. And again, this is a longer term projection. This is that's May right there, that's June, that's July. So the point is, a lot of these tools apply to the bigger picture. Now, it doesn't mean you have to trade this long term of a time frame, but if you have an indicator that's pointing down, like we have here, and like the seasonal is about to roll over, and then we see like a little 5 down and 3 up on a 15-minute, then by all means trade short term, but try to use some of these longer term tools to help get you on the right side of the larger move in the market. So here's another example of the longer term analytics that are freely available for everyone to look at, like fear and greed, CNN index. There's the website. You can just Google CNN fear and greed and it'll come up. And so this is a tool that I've been tracking. I've got the entire data history on this indicator. And so when you see it get really high or really low, that tends to be a time when you want to maybe look for a turn in the market. And of course, there's the daily sentiment index. That's another longer term tool. And so there's so much that's oriented to the bigger picture. So if we get a sense that the market is likely to turn the direction it's been going, or if it's going to keep going, using some of these tools, that helps us focus on the short-term, the direction of the market, kind of like over the next week or two. And if you want to be long only, if you think the market's going up, then that strategy might work pretty well. All right, now another thing to consider is, I of course watch like 15-minute charts all day long as part of my intraday stocks service. So I'm very tuned into the short-term charts. And I will just say that I do think that there's probably a little more noise. There's a little more kind of a proclivity for markets to have truncations on the shorter term charts, like right here. 1, 2, 3, 4, truncated 5. And so if you're trying to use Elliott wave in the short term, you've got to be pretty much in front of the screen constantly, and you got to be very good at counting waves, and you got to act quickly, and you may have to exit quickly to take a profit. And so, personally, I kind of like the longer term trading because it allows you to catch bigger moves without having to kind of kill yourself buying and selling all the time. But it really depends on what you're good at, what you like, what you have time for, what you feel like your skill set kind of applies to, and what tools you want to work with. But again, when you have like a longer term count, and then you can zero in and get a short term count that gives you, let's say you're bearish right here, and you have whatever reason to think that the S&P is making a top back here in early March. All right, and you get an initial 5-wave decline. Okay, so now you have evidence that high is going to be a significant top. So you can risk up to that high, which isn't a huge amount of money. So by using the using the longer term count to pick your expected direction of the next big move, but then use short term wave countings, wave labelings to afford reduced risk entries, that's the best way to apply Elliott wave. And use all these other indicators to kind of help assist in showing that there might be some kind of underlying tide that the market or the stock is likely to experience. So that's kind of it. Just to quickly summarize, I would say is, I'm part of Traders Classroom. I like to, of course, talk a lot about Elliott wave, but I also like to talk about using indicators that I find useful and that kind of put the odds hopefully on the side of the trade. And part of my job is scanning a lot of markets and a lot of stocks and ETFs to find a situation where a number of different disciplines of analysis are in agreement on which way something should move. All right, that gives me kind of like the bigger picture selection, and then I zoom in on the short-term wave count and look for that low risk entry, that confirmation that the trend is going in the direction that the longer term stuff says it should go in. And that's kind of how I construct the trades that I like to do. And so that's what works for me. And I would just say, again, if you want to be a scalper in short term, you got to move fast. You have to allow for a lot of failures. But if you use the longer term charts, like I showed with the Lockheed Martin, and you have a high confidence long-term count, and then you get a short-term count that agrees with it and affords you tight stop parameters, that's the best of all possible worlds. And that's the best way to apply Elliott wave analysis to trading. All right, so we'll talk a lot about other indicators as they come up, and maybe some course can be applied to any time frame. An RSI works on a 5-minute, works on a monthly, but I will continue to try to show things that I think are useful and kind of keep everybody in mind in terms of what time frame people are trading. But I do think that the kind of the top-down idea of helping you pick markets that are likely to keep moving in one direction, if you can do that, it's going to help your intraday trading as well. All right, that's it for today, and I'll talk to you tomorrow.
Keep your trader education going with 3 short video lessons per week using real markets, real charts with real learning. 3 times a week, published every Tuesday, Wednesday, and Thursday, our Traders Classroom instructor, Robert Kelley, gives a short video lesson to show you how to combine Elliott waves with other indicators to achieve that confident market view that every trader strives for. Learn more by following the links in this video's description.